Hey everybody, Eric here. I was lucky enough to randomly find Matt on Twitter, and I actually looked through your stuff a little bit, like I was just telling you, and I love a lot of what you talk about, and you have an interesting background. So first off, welcome to the channel.
Thank you. Thanks for having me. It's a
Yeah,
pleasure.
yeah, and I'm really looking forward to the conversation. So I figured, as always, it's really helpful to just start with a little bit of level setting, maybe get a little bit of your background. You gave me a little bit of a preamble, but I would love to understand two main things. The first one is, how did you get started in trading or investing, kind of whichever you more closely identify with? I think it's trading, but we'll see. And then the second one is just walk me through kind of an evolution from that start to where you are now.
Okay, thanks. Well, first of all, I'm just happy to be on. You're, Marine veteran. Like I was saying before we started the call, I always respect people that have such passion and work so hard. I think that's key for success in anything that you got to do in life. And I think the Marines probably represent that better than anything else out there. So just a bit of my background. My dad, he kind of loved the markets, but it was in his day job. It's just something he liked to do on the side. And so from when I was a really young kid, he always tried to kind of talk to me about it and stuff. And the first share I bought was Wendy's. I bought 5 shares. I think I was 8 or 9 years old, just because we used to drive to Florida every year in the summertime, and I used to stop at Wendy's. And my dad said, "Well, if you like it, buy some shares." So I bought 5, and I kept track of it for years. But really, what really kind of got me really into the markets was I think I was maybe 16, I forget now exactly, but I read How to Make Money in Stocks by William O'Neill. And that book kind of like blew me away. Like, my dad was a more value investor at the time, Warren Buffett type stuff. And I tried to kind of read that and glance at it, and it was boring. When I read Bill O'Neill's book, that was like, the angels sang, and I said, wow, this is really interesting. Because I was always the markets always appealed to me, but it just never really clicked as a passion. Obviously I was a kid, right? So
Sure.
but once I read that book, what I really liked about it was the charting section. I just found it so interesting that, because especially when you first approach the market, your only question is, when do I buy, when or what do I buy? And to see on a chart, which I'd never seen a stock chart before that book, to say, like, if you draw a trend line here, if this past this point, this is where you buy, and then this stock went up 200%, it was like, wow, that's how that is the secret for the markets. And I kind of went down my path, and I became a chartered market technician. I pretty much read every book I could on technical analysis. I majored in economics, and I basically traded ever since I read that book, even while I was in university. And that kind of landed me my first job, where I was a market maker, pro trader right at university. And also I became president of the Canadian Society of Technical Analysts. And that led to me, actually, I was a year out of university, and I was asked to come back to be a finance professor for university graduates. So funny enough, I was probably a year older than most people in the class, and I was teaching that class, and it's still being taught today. Actually, I don't teach it anymore, but it's a very popular course. And long story short, I became a chartered financial analyst. In 2020, I joined the U.S. Investing Championship, where I gained a little bit of popularity. And today I still invest for myself, and I have my website, Caruso Insights.
Awesome. So it's funny, I just really identify with how you got started. It's super similar to how I got started, where it was, essentially just bought a couple shares of stuff that I liked and looked interesting. I think that's so curious how, for a lot of people, that's how we get started, right? Is you start with what you see, what you know, and you're like, well, I like Wendy's, so I'm gonna start with them. So when you started finding this draw to technical analysis, what was your initial impression towards it? And the reason why I'm asking that specific question is my background is very limited technical analysis. I use some of it, but it's definitely a bit of a balance of technical, fundamental, and then a lot of just options data. So I'm really curious, when you were looking at or reading the book, maybe that's, really where it hit for you, but what drew you to technical analysis over the value investing that your dad was doing? Was it simply the chart, or what was it?
Well, most of the books at that time for technical analysis were mostly futures guys, commodity guys, because in the 80s, 90s, up until recently, technical analysis was like in the realm of commodity futures trading, not for stocks. Stocks was the respectable place where you looked at financial statements, and that was what you looked at. But I think when you're a young guy, you're 16 years old, I mean, risk doesn't exist. None of that matters.
Right.
You want to make as much money as possible. And so for me to see, so trying to buy a stock, I was reading, I think Benjamin Graham was one of the first books I tried to read where they talk about utility companies and a 10% return. And when you look in your bank account and you have like $500, you say, wow, I got to do all this work for $50. But so when I saw what Bill O'Neill was talking about in his book, and the first thing he mentions is about controlling your risk. And so it just kind of dawned on me, how do you control your risk unless you can time your entry? Even at a young age, it made a lot of sense to me. And as I jumped into the technical analysis kind of stuff, and all these guys were mostly futures commodity traders, and I saw the leverage that existed out there. So as a young guy, again, there's only one thing that you're focused on. So I said, with $5,000 or $10,000 of money saved part-time, I can buy, $100,000-$200,000 worth of like gold or crude oil contracts. And that's where a period of time when I was, really young, living at home and had an, account moves up and down of like hundreds of percent and, up and then crashes back down. Yep. It wasn't definitely not a stairway to heaven. I'll tell you that much. And so I just got immersed in tech. It was all about timing and all of that. And I became obsessed with it. And with time, now I use a lot of fundamentals in my approach, but the technical analysis served me well because my first job as a market maker and day trader was, really, when it comes down to it, it's all technical. Okay, it's not always charts. Some of it is also reading market data, like you mentioned, options data. But you're talking about the mechanics of the market. So it's really a different world than fundamental numbers. There is impact sometimes. If there's news that comes out, you have to assess the news. What are they talking about? And you learn that with time. But 90% of what you're doing is technical in nature. So it was a good background, especially for the first job.
And I guess you must be a mind reader, because that was actually the next question I was going to ask you. So talk to me a little bit about your time as a market maker. You said you spent about 6 years doing that?
Yeah. So 6 years. Sorry, I didn't mean to cut you off.
No, go for it.
So it was 6 years. One of the big banks here. Then unfortunately they closed the division. Was post financial crisis, reduced risk, and I did a small stint at another brokerage before I went on my own. But the interesting thing is that when some people like kind of hear me speak now or whatever, say, "Oh, you learned a lot of the, what you do now at the bank," and ironically, I remember I showed up. I was 10 years younger than the next guy on the desk. I was by far I was 22, the youngest guy. And my supervisor said, because it was like one of those keyboard driven entry systems. It was like F1 is buy, F4 is sell, F3 is short, make us money. And that was really pretty much all I had in terms of trading, So the only training I got was really when a colleague next to me, saw, it was saying, "Hey, Matt, why don't you try this?" You saw me doing all these charting and stuff, and you showed me the kind of the simpler methods they were doing, the market making methods. And no one ever puts that in a book because it's such minute, detailed information. And I learned quite a bit there. So, but in general, that was day one. It was like, this is buy, sell, and, let's see at the end of the month how you do.
Yeah. Get to clicking, guy.
Yeah, pretty much.
So if you were to synthesize, I don't know, maybe like the top 3 or 5 things that you learned as a market maker, what are those things? I think that first one is an interesting point. You feel free to add that to your list, because I actually have a few friends who are market makers, and I'll talk to them sometimes about trading and whatnot. And it always surprises me. They have very nuanced information about their firm's approach, but if you were to talk to them about other things, they might know it because they're interested in it, but they're not getting it from work necessarily. And that always surprised me, just how specialized a lot of the knowledge was for them. But I'm curious what your maybe top 3 to 5 takeaways were from your time there.
Well, one is, it's interesting. Most people, when they approach the market, it's like big picture stuff, fundamentals and that, but there's a microcosm to the market, the mechanics of the market, much like, you were in the military and yeah, everyone thinks about the strategy of war, but then there's actually the actual day-to-day of what you're doing, which are the 2 different skill sets. So, and if ever you're trading in a volatile market, even if you want to hold a stock for a 20% return, but if the day-to-day swings in a market like we're dealing with now are 5 or 7%, well, if you step on, the wrong day and you're down 7% the next day, that dramatically impacts what you're doing. So just the importance of the short-term mechanics. And it's an important part of the toolbox to be able to control that, even that short-term risk for long-term returns. A second item I would really say is very important is you get to read the buying and selling pressure, the buying and selling. In Canada, we can also see the broker numbers, so you could really read the data better. And luckily, I started before algos were there, the HFTs rather.
Yep.
So I really saw the impact of institutional investors. It was much clearer. You can still see it, but it was much clearer before. It wasn't distorted by like them trying to hide their tracks with algos and stuff like they do now. So just that really, they really drive the trends. And if you're going to get this big uptrend, you'll see that same buyer. And you could notice it after time, like, oh, we'd say, number 9 is back, because that'd be the broker code. And bang, he'd start buying all day again. And you try and get ahead of him or whatnot. And if he disappear, you try and get out before the stock would come back down. So just the real impact of institutional investors. It's not the retail investor. It's not the day-to-day investor that moves a stock. It's institutional. That's so important. And I guess, let's say a third would be the world I was in, especially where I'm Canadian. It was a lot of resource companies. And so, I learned a lot about the each company has a lot of specifics. So you want to understand your company specifically, but to be a good investor, you also want to understand the macro picture. So because I was in so many of these commodity stocks, like, oil, gold, they're really, you could be in a gold stock and oil opens down, 4% the next day because of some geopolitical problem in Kazakhstan or in Russia, and so it kind of made me ultra aware of all the variables that affect the stock. There's technical variables, there's the individual stocks, fundamental variables, there's the institutional flows, there's global macro problems. So I think some people, when they hear me talk, they say, well, you have a lot of experience with different things, just because I was kind of in a world where it kind of forced me to, each day you wake up, you get slapped in the face. You want to stop and say, whoa, why did I get slapped this time? And you learn that skill set. And it's just like this constant learning process. So those are the 3, I guess, big takeaways that I got from that experience.
That's pretty awesome, especially that last one that you mentioned. That's one of my favorite things about the markets in general, is I always find that if you actively trade, you generally are just a more informed human being, because exactly what you're noting. And one of my favorite things about the markets as well, especially in the US, like, we have a very polarized political environment. Every article you read leans one way or the other. But a lot of financial stuff is pretty straightforward, right? It's like, what impact does this have on making money? And I actually always found a lot of reprieve in that perspective, because I just get tired of reading the rest of the news. You're like, okay, who wrote this? What's their angle?
Right.
But that's interesting. So what led to you jumping ship as a market maker to go be a professor?
So actually, I did them simultaneously. So
okay, got it.
As I was trading, it was a part-time professor gig. So I had 1 or 2 first it was 1 section, then 2, but it was night classes, and only the first section was during the day. And I was a young guy, 22, so I had to ask my boss permission. So I'd have like, that's some of my students. Some of them are professional traders now too. And I'd be in the front of the class and I get a phone call from my buddy saying, hey, look, you want me to hit the bid on this? He told me to let me know if it's coming off. And okay, I'd hit this. So I'd be giving like trades over the phone back then, so that was fun, but it was too much. So after that, I spoke with the university to have it only night classes.
Yeah, well, that's kind of cool that they're accommodating you, though.
Yeah, it was fun. It was a fun time.
So what was your experience like as a professor dealing with just students who are interested in it? And again, the caveat to this question is, when I was working on my MBA, I actually took a handful of trading courses, derivatives courses, and I thought they were fucking abysmal. They were ancient. It drove me nuts. I was blown away that they were still trying to teach that stuff. So I'm really curious what your experience was like, creating materials and whatnot, and just what the students were like.
So I was kind of fortunate. When the school reached out to me, it was a class that was like loosely based on technical analysis. I didn't get the outline of it, but it was kind of that professor's own take on things. And they said, look, you're the president of the CSTA, and we'd like you to make a class. So I'm a CMT charter holder. And so I reached out to the CMT Association if they had any kind of tools. And they actually had this program, the MTA Educational Foundation, where they actually help, professors get up and running. So they had kind of like a curriculum. So I kind of took that, and that was probably 90% of what I used to. It's basically the CMT program, like level 1 was probably 80 to 90% of what I taught. And then on top of that, so the name of the class was how to build a profitable trading system.
Oh, cool.
So I took basically all these technical tools, but they have access to Bloomberg's and stuff like that, terminals. So, the course, had a project where they had to build a trading system. It didn't have to be complex,
sure,
but it had to be like a moving average crossovers or, 10-day breakout, whatever it would be. And so I kind of took all of the technical tools, but I made it that there would be an application portion to it. So that was fun. It was interesting. The only, the reason I kind of stopped teaching at a certain point was, time became difficult. But out of a class of 50, 60 students, you'd have that 4 or 5 people that are really into it, and everyone else would be arguing for grades. Oh, I got a B plus, could have an A minus. And if you do it for one, then after, so it just kind of,
Yeah.
I want to teach people who actually want to learn, not because they're there
Yes.
to pass the class. And with trading, I was so busy. I just, at a certain point, I said, look, I had some, some friends who wanted to teach, or also, in the field, and they took over the class. But that was my experience.
That's awesome. Because I find myself in the same exact just scenario where I really do enjoy teaching, but I like teaching people who are interested in it.
Right.
Because I could totally see the drag on, just fighting over somebody's grades. Well, B plus, A minus. Well, you should have done better. Then you get an A minus.
It's like you have a bad trading day. You come to the class, you teach. Like, you don't feel like being here that day because you're thinking about what the heck you're going to do with your position tomorrow. And then this guy saying like, oh, you gave Jim like an extra 2 days to work on the project because he said he wasn't feeling well. I wasn't feeling well either.
Oh my
And
God.
it's like, oh, you know what? Like these are not 14-year-old kids. Like you're 21 years old. Like,
Right.
like just,
you're an adult.
This is an application course. This is right before you graduate and enter the workforce. My expectations are that you're here to learn because you want to apply, but that's university, right? We're all there. We've all been there at some point, but that was the situation.
That's interesting. And then, so you participated, you said, in the U.S.
Investing championship.
Yep. Okay. And what was that like? I've heard of it before, but I'm completely ignorant to it. I don't know what the, the program is or anything like that.
So it actually goes back to the 80s. I think some of the early participants were Paul Tudor Jones, who's the hedge fund multi-billionaire, and just a lot of the David Ryan, who's a 3-time champion. Mark Minervini was champion. Just a lot of the popular names that you know. And so that went back to the 80s, and it actually had stopped for I think a good 15 years because the guy who runs it stopped to do his own hedge fund, and so he came back to restart it in 2019. And so when I saw that the competition already started, and all the guys I looked up to starting out, were champions of this. So I said, wow, I got to get in there and try my hand at it. And so in 2020, I joined, and I was always top contender. In September, actually, of that year, I was in first place with 426% return, which broke the 9-month record of the championship, going all the way back to the 80s, which I was proud of.
Yeah.
And I ended up finishing a top contender, but I didn't finish. I kind of took my foot off the gas. I didn't realize stocks were going to go vertical, or else I would have had even a better return. But I finished with 346%. But it gave me, I think, some good exposure, which I appreciated, and it's given me a chance to teach again. So that's been a lot of fun.
So if you were to summarize the experience, especially, I'm curious, what does that experience feel like for you as compared to just your normal trading career? Like what's the difference between what you learned in that championship compared to just your regular trading?
So it's funny because I didn't have that pressure since I started trading. So when I started trading, I until I started trading professionally, I was trading for myself. So if I quadrupled my account in futures contracts, and then after I made a mistake and it fell all the way back down, I looked like a fool. Only I knew that.
Right.
So, when you love something, you're more concerned about being good at it necessarily than making money. Like, I mean, the point is to make money, but that's going to come with executing well.
Right.
And when I started trading professionally at the bank, and suddenly I had a manager watching my P&L saying like, oh, no, you can't have that kind of drawdown, or hey, Matt, how come it's 2 weeks where you're struggling? You're doing great last month, and this month you're down. Just that feeling of someone watching over my P&L when I started, that was the hardest part. I found that just psychologically, like a pressure on me.
Yeah.
So then I got used to that. That was fine. But then when I entered the competition, and this was, the competition was my professional account. So it wasn't like I didn't take a small amount of money and say, hey, let's rock it. I approached it like with my professional funds, that this is how I'm going to trade. And then so suddenly, like the whole world, whoever's watching the competition, which it became very popular because myself and 2 or 3 other guys were really knocking it out of the park with triple digit returns. Suddenly to have this month to month where it's like, you're trading for money, but then after saying, oh, but I also, am I out trading the other guy? And it created this pressure where it's fun, but at the same time, like my aim is supposed to be a profitable trader. It kind of created a bit of a distraction. That's why I didn't do it in 2021. I said, I want to kind of like refocus, and a lot of fun, but it creates kind of this like negative pressure in a sense.
Right.
So that would be the con of the competition. But the pro is that I met some phenomenal people, some really nice guys, and we still chat together, and so that's been a lot of fun.
Good. That's awesome. It's funny you mentioned the part about having kind of a second set of eyes on just your performance, because that's one of the things that my mentor started with me early on. Is first he forced me to write out like a trading plan, but then we ended up doing like a monthly review where it probably obviously nowhere near the same degree as you, where, you know, it's like P&L for a company and they're like probably looking at you every day. But he and I would do like a monthly review, and I found a lot of stuff that I would rationalize in my head because of an ego. You know, somebody starts poking holes and you're like, shit, yeah, I'm not making the greatest decisions here. And I found that to be like actually tremendous growth experience. So
Yeah.
it just resonated with me when you mentioned that, you know, as part of your experience. Was it like a daily, you know, review of your P&L with your boss, and then like a weekly or monthly roll up to your boss's boss or something like that? Or how did that work for you guys
No,
while
you
you're
know,
there?
to be honest, it's funny. Like it was a very laid back
Oh,
experience. So as long
interesting.
as you made money, you could pretty much do whatever you wanted. Like no one,
Oh,
as long as you were making money, and almost every day, week, month, I was making money. It was a fairly, at that time, it was a very consistent type of strategy.
yeah,
It's only if you got into like a bit of a drawdown or something where there'd be a conversation, you know. So
got
that
it.
was kind of, I remember 2010 for me was a really big year. It was
Mm,
probably as big as, almost as big as my 2020 year. And so then, you know, whenever you have, I've had the experience, whenever I have a lot of big returns, then after, that's where I would get hit, because, you know, you get maybe overconfident, or you get a little
yeah.
bit cocky, or now you're just so blindsided by profit, like your mindset's not in a good place. And so then after obviously that volatility returns, they said, well, we don't care what you made last year. I just want to remind you that was last year's profits. Now this is a new year. So I had, you know, a bit of talking to at a certain point where it's like, okay, like, you know, in your mind, it's like, oh, I made all this money last year, so if I give a
Right.
little
Let's
bit
just
back.
average it out.
Yeah, but no, they're like, no, no, no. That was this is a company that was already last year's earnings. This is a new year that we don't care about last year anymore, you know?
Right.
So I learned, you know, my buddy told me, he was, the guy who sat next to me, that's like, you're only as good as your last trade, Matt. Always remember that. So just never blow up, because they don't care what you did before. It's what have you done for me lately, kind of thing.
Well,
So
yeah, that
yeah.
man, that's crazy to me. Like, I get it, but like, as I don't know, like, I'm a lifetime retail trader. So if I have a down year, as long as it doesn't hit like my CAGR too hard, you know what I
Mhm.
mean? Like down years might happen. So it's just, that's an interesting perspective where you might just
Yeah.
knock it out of the park. And then the next year, like, what the hell's wrong with you, guy?
Yeah, pretty much. Yeah.
That's
Yeah.
wild.
Yeah.
Um, all right. So we talked a little bit about your background. I would love to know just a little bit more about your participation in the championship. So, what was your general approach during that? And again, just for my own edification, what was like the time frame that you guys were trading? Like, how long does that championship go for?
So it's the full year. So it's
Okay.
from January 1st to December 31st.
Okay, got it.
Yeah.
And so that was, you said 2020, yeah?
That's right.
Okay. So what was your approach when, you know, January 1st, whatever the first trading day was, you know, what were you thinking to start that championship? How are you going to crack the nut?
You know, my goal is really just to perform. You know, that's the funny thing with the market, you know, is you could think it's not like sports where I'm going to try extra hard to make it work. In the market, I found just being as disciplined as possible is just your
Mm,
best chance. I mean, the market may be conducive to your strategy that year, or it may not, because sometimes, you know, you're not a bad trader. It's just the strategy you're implementing. This current market environment is not great, but you know, over the next 5 years, you're going to make a ton of money. But over this
right.
3 months, it's not. So really, my goal is just to be as disciplined as possible, and just really make sure I apply my strategy to a key. And it was just a great year for it. And the only difference is I started the year flat, so with no positions. Usually I'm always trading. I said, okay, I'm gonna really start at zero, and take it from there, so there's no impact of like last year's decision making. And worked out really well. I was you know, I think there was two big things that really worked in my favor that helped me to make the you know, the monster results. Were just basically, I was actually in Florida on vacation in February when COVID was starting, and all
Mhm.
of my rules had me get to cash. And so I still remember, you know, like my wife was at the beach with the kids, and I'd go up in the afternoon. Sorry, one of my son would sleep in the afternoon, so I'd go up with him. Like my wife would be at the beach or at the pool, and I was have CNBC on. I see that the Dow's down 1,000 points, 1,000 every day, and I was like, it was incredulous to just see the market get smacked every day.
Yeah,
So to be in 100% cash was a big advantage. I was
of
already up
course.
in January, and then full cash, and then right near the lows, you know, my understanding of monetary policy, the Federal Reserve, I remember it was, I think a day off the low. And when the Fed came in and said, you know, we're bringing rates to zero, we're doing QE, we're making reserve requirements zero. I told my wife, it was a Sunday night, I said, that's it. The bear market's over. She's like, come on, the world's shutting down around us. There's no bull market coming. I said, the bear market is over. That's what the Fed's doing. And then technically my technical tools triggered a couple of days later because I'll always wait for my tech. And so it's like, I said, it doesn't make any sense. The world is in a chaos, but the Federal Reserve is super accommodative. My tools are telling me it's a new bull market. And I sat there and I told myself, what are the stocks that are going to most benefit from the situation? I actually went back to like the 1914 World War I era because I said this is a health war. And so I looked at like the steel stocks from 1914, Bethlehem Steel as an example of what to expect. And I was able to key on like some really stocks that would really benefit for like Livongo was for health. Fastly was an internet provider play. And the Trade Desk was a digital advertising, everything that would benefit from being at home. And kind of like everything in the strategy really fell together and it was like monster run. So that's really, and it was really just a matter of applying the strategy. I didn't do anything different or extra. Some people think, did you go extra leverage? Like, this is my livelihood. I don't have a plan B. So I can't say that, to win this competition, I'm going to risk my, my family's, money situation, so it was really just being disciplined, but, also being aggressive.
Right. That makes a ton of sense. So what were some of the indicators that you saw that made you make that transition to cash? Because I think that obviously that was a fantastic call. But I am curious what led you to that decision, and kind of like when did that, when did those pieces line up that you're like, okay, time to go to cash?
So there's really three basic things that I'll work with to go to cash. One is your own positions, how they're acting. So because I came into the year without any positions, I had one really good trade early in the year where I think I like brought my account up 20%, but I closed that out. And then all the new trades I initiated started to break down. Okay. And then, but rather than initiate new trades, William O'Neill tracks what he calls distribution days. So he looks at the market index to see if there's, increased selling on down days, to see if there's a shift of what institutions are doing. And that was picking up. At the same time, I look at, I don't want to get too technical, but each day there's a number of stocks making new highs, 52-week highs, a number of stocks making new 52-week lows.
Oh, so like an advanced decline or something like that?
Yeah, but it's really, it's similar, but it's looking at 52-week highs versus lows. So when there's more stocks making lows than highs, that's a negative. And if you get 3 days in a row, for me, that's a big negative. And right near the top, that's what was really key about that market in 2020 is everything started to break down. Like it wasn't like, this sector's a little bit weak. It was like, no, it's cross the board selling. So that cross the board selling and my own, recent sellouts of my stocks was just had me in cash. I said, there's no reason to be long. And I was able to just sit back and see the carnage from the sidelines.
And when you're trading during this championship, are there limitations on the products you can trade, or can you trade equities? Can you trade derivatives, or how does that work?
So there's different categories. I was in the stock category. So with stock only, you could use leverage margin, but standard, whatever your broker, provides, nothing abnormal. And, but only equity. So there's no options, no futures or anything.
And then can you trade both sides? Can you be long in and okay, got it. Yeah. So during the COVID drop, when you get that sort of indicator, that's like, okay, we're seeing 52-week highs and lows and, just a breakdown between what you typically look for there. Did you start saying, and your positions, obviously, like you're, citing, we're looking hurt other than that one outlier that was performing. Did you say, I'm going to trade the short side here? Or did you just say, I'm going to wait and see how this thing pans out?
To be honest, I'm not a good short side trader. So I think we have to all know our strengths and weaknesses. Like
me neither.
My first year trading pro was 2008. So it was the financial crisis. I had a good year, especially for a first year, a novice, like pro trading. I think I traded the long side that entire year. I just, I was always able to, pick my positions, pick my spots, short term. I did some shorting, like I have my technical tools, but I don't personally feel comfortable. I think the main reason for me is it's always appealed to me what's called the asymmetry, so, on the upside, you can have a 5% loss is where you say, look, I'll get out, but I have a stock that can potentially go up 50, 100, 200%. On the short side, what's great about the short side is it happens fast. So if you're right, it's like, wow, big profits quickly, but a stock is going to break down 10, 20, 30%. You can't get a 300% drop. The stock gets to zero by then, So for me, like the risk reward, I just prefer that long side. And I think I'm an optimistic person by nature. So I like to always feel things will improve and get better at some point. So I don't like living in that negative, world of trying to be short. I'd rather pick my points and try and get long or be cash and just get ready for the next, up leg. That's my personality.
So if you play craps, you pay the pass line. You don't play the don't pass. I don't know if you play craps, but that's.
You know what? I've been trading my whole life, and besides a bit of poker with friends, to go somewhere where I have a negative edge, a negative expectancy, and put money on the table, it goes against everything I believe in. I want to be the casino. I don't want to play in the casino. That's all. I'm not a big craps player.
That makes a ton of sense.
Yeah.
But yeah, that's a big thing in craps, anyways. Is the pass line is what the whole table's typically rooting for, and the don't pass typically is playing with the house, essentially.
Okay.
But yeah, that's funny. So it's interesting that you say that, because I almost always have some sort of short market deltas on, but they're always painted against a generally long disposition portfolio. So it's interesting for me if I'm shorting something that's going to be via like short calls. I have tried shorting stock a couple times, and I don't like it. I don't like just the carrying cost. And then sometimes, I don't know, it's probably just because I'm relatively new to it, but the liquidity part freaks me out sometimes. If it starts to dry up, I'm just so I tend to avoid that.
It's funny what you mentioned though, because I remember once I was having a discussion with one of the higher ups of the bank, and we were just just talking back and forth, and you were talking about, there was a very small options trading team, much smaller than the equities. And I remember asking, I said, how they're performing well. I mean, do you have a preference yourself, stocks, options? Like, no, he's like, I'm more a stock guy, but we like having the options guy. They don't do exceptionally great. Whenever there's a really bad market or a steep decline, the options guys are always like, are always positioned to make more money if the markets are dropping, for all the reasons of how options are priced and, the way things change, So it's like, it's kind of like always a good hedge to the equity division. So it's funny that, the way you think is really typical of an options trader, I guess, or someone with that dual personality of options and equities.
But that's exactly it. I'm sure you've heard the saying, but the markets crash down, not up. So
right.
It's always having something ready for that crash down. To me, it's interesting because during the bull market post 08, that was a tough trade to keep on, because after a while you're like, okay,
well, in 2011 in a row, okay, but
yeah, it's like 4 years in a row you're getting killed on this thing, and you're like, come on, give me a payout here. But when it does hit, it typically is pretty nice. So when the market, going back to the COVID drop, market capitulated. You saw the stuff come out with the Fed. Obviously, Big Daddy J Powell turned on his printer and just let that thing go into overdrive.
That's right.
So what kind of, other than the Fed's statements, what technical tools were you looking at that started making you comfortable with like your re-entry post-COVID?
So when the Fed statement came out, I always use the technical side to confirm my bigger thoughts. So I'm just a natural, I guess, strategist. So, even when I was day trading, I was always reading like macro news or company news, but I always use the technicals to confirm whatever my thoughts are, because you could have this great idea and be totally wrong. And it could be such a well argumented argument. I mean, if you go online, you read some stuff on different websites and they say, wow, this guy he's thought of everything, and then he's dead wrong, So I find the market will always surprise you. So even though all that came out by the Fed, I was waiting for the follow through day, which again, William O'Neill teaches in his book. Very simple concept. Basically, what he looks for is, the first 2 or 3 days after market bottom, you can't really look at those to confirm a new uptrend, because that could be short covering. Just people kind of saying, I got to get out. But starting on the 4th day or later, if you get a day where the market's up like, 1.25%, 1.5% or more, and with increasing volume, that's a sign that institutions are confident to come back into the market, and you may have the beginning of a new bull market. So when I saw all that Fed news, I was really waiting for that follow through day or net new highs to come out. And when I got the follow through day, at that same time, I saw all these great setups in these stocks that would benefit from stay at home. And it was like the perfect textbook setup. And that really is what allowed me to get in there aggressively.
And just a personal question I have for you out of curiosity. You're in this championship, market's going to hell. You decided to go to cash. How did that feel? Because I imagine my mind would be racing like, oh my, other people are shorting right now. Other people are making money. Or were you just more focused on, this is my real money, so I'm going to do what I need to do to protect my real money? irrespective of, the impact of the championship here.
Yeah, absolutely. And that brings up a really good point though. This whole idea of the championship and some people, let's say they're training just for fun, or I mean, but the championship was real money, but
Right.
obviously I don't know other participants to what degree they're invested. I mean, the statements I'm handing in are my company statements, you know what I mean? I don't know
Right.
what everyone else is handing in, I think the minimum is 20,000 or something. I'm not sure. So there's just somewhat of a minimum, but that really goes back to, I think, people underestimate what it's like to trade for a living.
Mm,
Even when I was at the bank, especially now that I trade my own capital, there are so many different pressures that people don't realize. Because let's say you have a full-time job and you have a trading account, nobody wants to lose money. But at the end of the day, if you mess up, you're still going to be able to eat that night. You're still going to get
right.
paid. And for myself, when I'm trading for a living, first of all, there's a higher tax rate because now this is your income, right? So you have a higher tax rate, which is against you. Your capital, you can't use it for other things in life. You're using it for this. And if you go into drawdown, every time you go into drawdown, that's less buying power to make more money in the
Right.
future. That impacts all your future income. And then on top of that, you have your living expenses that come out of your trading. So there's a lot of hurdles and a lot of pressures that you have trading for a living that don't exist when you're trading part-time.
Right.
So maybe just because I'm used to that. And so in the championship, it's just like, look, it's again, discipline, execute your strategy, even though other people are doing whatever they're doing, be diligent, be disciplined. And because again, I can't risk blowing up everything just for a championship, but
Right.
there's really a really big difference between trading pro and trading as a side business, just like
Yeah.
drastically different on the mentality and the psychology.
Yeah. It makes a ton of sense. I was curious because, and it really resonated with me when you started talking about some of the impacts of the championship, just
Mhm.
on your mental approach
Yeah.
to the markets, because like by nature, I am just a hyper competitive human being.
Yeah.
So,
Same here.
you know, during the COVID drop for me as a retail trader, I literally couldn't have cared less. Zero
Mhm.
difference. Like I had some positions that were hurting real bad. I had other stuff that was doing just fine, and it was all whatever because I knew if I needed to roll and manage positions sooner, because I was mostly trading index ETFs. I was trading like IWM.
Mhm.
So I didn't care, right? If I have to wait 3 years for it to make a move and whatever, fine. But if I was in a championship, my mind would be racing. It would be, what am I not doing that, other people are doing to take advantage of this? So I actually think it's really impressive, that you're able to balance the pressure of trading, for your livelihood, but then also keeping really your priorities in place
Yeah.
despite that competitive environment. That's really impressive. But I think that also highlights a really important skill set that you've developed over time as a trader, right? Which is to be less mentally perturbed by the market moves and staying disciplined. So it's an
Yeah.
interesting, yeah, it's an interesting culmination of that.
I think it's really interesting that all the traders I know, like the guys I traded with, or even other that I've met through, online and stuff, people who trade for a living or have traded, let's say, even if you don't trade for a living, but you trade aggressively for many, many years,
Hmm.
it's funny. We can tend to have a lot of similarities in how we view the world, how we think,
Sure.
even in politics, very similar views. And it's like really strange. Like you really become this subset. I think it's the market kind of forces you to be a very independent person,
Yeah.
self-reliant, confident. You have to read between the lines. You need a news statement comes out. What is that person really trying to say? Or is the CEO trying to make a bad situation look good? You have to be resourceful. You only have so many funds. You got to make these work. You got to, what are your costs? How do I grow this? So I mean, I think that's why even yourself as a Marine, it's these are the things they're trying to instill with you. And I always compare the markets with battle, with war. I mean, the
Sure.
book, The Battle for Investment Survival by Gerald Loeb, which is one of the classics. I find that's probably the best titled book of any book, because it's like, for investment, it's really a battle for investment survival. The market's a hard place. I mean, if you're going to buy stocks, say, oh, this for retirement, 40 years out, I'm buying AT&T. Okay, you'll do all right. I mean, but
Sure.
that's not active investing. If you
Right.
really want, like, that's not a business. That's the same like buying a condo and renting it out. You can't say you're running a real estate company. You know what I mean?
Right.
So so most traders, that psychology, what it builds into you because of the adversity, and there's months where the market's hurting you and you have to get the confidence to come back, and it really creates a specific unique set of skills, mindset that I think now I was, talking with my wife and some friends, and with all this COVID stuff, and so many people are down and they're having a hard time. And you start to realize when you're through always dealing with your day job, where there's an adversary kind of like attacking you all the time, you kind of become almost numb to it. It's part of
Yeah,
life, and I got to get over this. And it's just another hurdle to success. But then, you kind of realize that that's not normal for most people.
right.
That's not most people's day-to-day life. They have a nice job, and that's great. It's just a choice of livelihood. But the skill sets that we develop as active investors and I think it makes you a very strong, independent, confident human being. So if you can get through all the adversity, much like I'm sure, like if you can get through Marine boot camp, you come out the other side a different person, a stronger person. So I think that's something that's a life skill that you get, that you won't, you don't even know that you're going to get by getting into this.
I think that that's a huge point. And I think that another thing that I would add on that I find that most traders identify very closely with, not always the same approach, but the way that we perceive and assess
Mhm.
risk is very different than most other categories that I see. And I find that to be useful just in general life, right? I mean,
Yeah.
even using COVID as an example, there's different perceptions of the risk and the way that we mitigate the risk. And I
Yeah.
think trading, at least for most of the traders that I've had the pleasure of talking with in terms of approach, risk assessment is always something that's top of mind. It's
Yeah.
not always, a huge concern, but definitely top of mind. And then the other thing that you were saying that really resonated with me was just the concept. I haven't met a successful trader that's been in the business for longer a decade that isn't disciplined. I haven't
Right.
found one. I found a couple that were really lucky early on and then they stopped, which you can consider that discipline of some sort. But, I've met some people like that just hit a good bankroll early on and then switched to long-term investing and, let that sit. But I haven't met an active trader that's been at it longer a decade that hasn't learned discipline
Yeah.
and the ability to follow a plan. Um, so something I'm curious about with you is you were talking a bit about institutions driving trends. This is a little bit of a nuanced question, but I'm just curious your take
Sure.
on it. What do you think about dark pools?
Well, in what sense? I mean,
I'm curious. So to just give, for anybody that's listening that may not be familiar, essentially dark pools are a way for
mhm,
large institutions to send block trades through.
right.
And obviously they'll have a pretty significant impact if they were traded on the open market, may not be able to get a full fill, prices be all over the place, all that kind of stuff. But one of the main benefits to a dark pool is a little bit of obscurity and, movement. And I'm curious, when you're going through using institutions, it seems institutional volume is like part of your information data gathering to base
Right.
decisions off of. How do dark pools, factor into that at all? Or since they're not traded on the open market, are they things that exist? They exist, but they don't necessarily impact your deployment as a trader.
For myself personally, I don't think it really impacts what I'm
Okay.
doing. That's really, I think the biggest impact there is if you're a very short term trader, like what I was doing, market making, pro trading. There's more of an impact, significant.
Got it.
But most institutions, they're going to cut up their orders. They're never going to go to one venue.
Right.
So dark pools is going to be one venue they're going to go to. And look, I mean, I don't have the stats behind me to go over all of this, but like, basically, let's say they send 20% to dark pools. That's probably going to be like across the board going to be a consistent number. So the majority of the volume is still going to trade on the open markets. And at the end of the day, it's that demand and supply. If the sellers are being absorbed by these big buyers, that's going to come through in price and volume. And I'm
Right.
looking more for trends that last several weeks, at least 2 months. And so that very small nuance is not going to really hide the fact, if you're the Fidelity Contra fund, your $130 billion fund, you want to have 1% of your portfolio in a stock that's $1.3 billion, and the market cap on that portfolio is $20 billion. So that's, you need to buy 5% of that company. The fact that there's dark pools or not is not going to impact that. It's not going to stop the impact that you're going to have on that stock price. That's the
Got
way I
it.
look at it.
Yeah, that makes a ton of sense, and that
Yeah.
leads me to my follow-on question. And you've answered some of it, but I'm curious, a more specific answer. So, like, obviously, the time frame impact is different. What time frame are you normally looking at, if there is a normal for you, or does it vary widely? And if so, what does that range look like?
So, I mean, if I get into a stock and if it falls tomorrow and gets me out, I'll be out tomorrow. But
Okay.
my holding period, my aim is going to be at least 4 to 6 weeks, up to 9 months or so. That's what I'm looking to. If the trade is successful, it's going to be 6 to 9 months if it's a real rocket trade. If it's mediocre and I'm taking my profits because it's not going to be the big move that I was expecting, I'm probably in it for 4 or 5 weeks and I'm taking my profits. So that's kind of the two sides of what I'm probably doing typically.
Got it. Okay. And to start with just the risk understanding first, when you find a stock that you're interested in, what is your general approach to deciding how you're going to manage risk in it?
So the way I've developed my strategy over the years, the way I deploy my risk now is every trade has the same risk all the time. My position sizing is standard.
Okay.
Regardless of the chart or the volatility, I have a fixed maximum loss that I'll take. That's a fixed amount of my account. And I'll build my position over time. So that's also a way for me to avoid gap down risk. So even if, let's say I want to have, I'm a concentrated guy, I'm an aggressive guy. If I have a third of my account in a stock, I don't want to do that day one. Because if I do a day one and they announce, we expect sales, sometimes there's an early announcement, sales are going to be a little lower than we expected. We open down 20%, I'm going to get hit pretty hard. So if I want to get that 30% exposure on a stock, I'll do it over a number of days or a couple of weeks so that it's going my way and I have some profit cushion to buffer my initial capital at risk. But even as I do that, my maximum risk will stay the same. So I end up using kind of open profits to finance additional risk.
Got it. So when you're looking at, that's an interesting perspective. So if the position side is generally standard, again, regardless of the product, are you using, I assume then, just like a percentage of the position size as your max risk in that position?
So I just think like kind of unique that for me that I've never seen anyone else do is I call it the Caruso dollar stop. So basically I set
Gotta name it. I love that name.
I gotta name it. It's so funny. I created like an investing course and there's all this stuff I'd been doing for years. And when you're teaching someone, you got to name these things.
Right.
And I'm just horrible. Like if you look at some of the names I choose, it's just like literally like what I think of it. Some people have these like, my voodoo tool and the XYR, I have the worst names possible. Anyways.
I like that one though.
Yeah, I guess, I'm sure it's out there somewhere, but
yeah.
So basically my initial position will be a percentage of my account, but I'll put it in dollar terms day to day. So it's easier to deal with. So, because, if I buy and the stock falls X number of dollars, I'm out instead of calculating a percentage.
Got it.
But as I add to that position, that initial dollar stop doesn't get bigger just because the position gets bigger.
Got it.
That's a way for me to build a position size, but never risk more than what I initially risked.
Got it. And how do you balance, giving the position a little bit of room to move, so that you're not prematurely stopped out with controlling your risk? Like, what's your mindset with that?
Yeah. And so that's a good point. And so whenever I make a purchase, I usually wait for it to advance at least about 5%, so a lot of the stocks I deal with, this will probably be different if you're dealing with a utility stock or you're dealing with a penny stock, which have really different on the two extremes in terms of volatility. But, for most of the growth stocks I deal with, I just through, I guess, experience that I've worked with, once it advances 5% or more, if you get another good buy signal, I have enough breathing space for normal volatility if I add to that position. I just noticed I used to get in trouble sometimes where I'd buy a stock, it'd go up, 1.5%, pause, and I got another buy point, and okay, I'll buy some more. So basically, I'm building this big position all within a 1 or 2% range. So here, by the time I put on a full position, it's probably advanced 10% from my original purchase. So all of that gain in my initial low cost buys give me a lot of breathing room for normal volatility. I mean, if the stock dropped 20%, I'm stopped, but that's not a normal downside move for a stock that's in a bull market, So
right. Okay. Yeah. And then when you're deciding, for me, I always term it scaling in. That's actually a big part of my general approach too, is like I call it like a trade allocation, however much money I'm going to put into a specific trade. And then I come up with scaling rules. So my initial outlay will be X% of that total amount of money. And then, initial scalings from there.
Which is hard for a lot of people. I mean, like we have the same mindset.
Yeah.
For most people who come to the market, and I've noticed as I've interacted with more people, is that, they have a hard time thinking that way. For them, it's like I buy and when do I take my profit? To think that you're adding to a stock that you're making money on is a unique mindset that people have to get used to typically.
Yeah, yeah. Oh, absolutely. And sometimes it's even difficult, if you get a big move in your direction and then you're like,
Mhm,
now what? Do I just take this profit and walk away? But
mhm.
anyways, I'm curious when you're deciding to scale into, or let's say if the position's moving in your favor, how do you approach scaling? What's your thought process there?
So this whole part of it becomes really my technical analysis
Okay.
base, So I always try and start my positions when the stock is making a larger base. And what I like to do though is all of the swing trading tools, the technical tools that I use from my years of being a market maker and pro trader, which were so short term. I use a number of those tools to keep adding as the stock is breaking out
Got
in
it.
my direction. So I kind of bring a larger base structure, but I time that with smaller type of trading patterns. And I got to that point because at one point I remember I forget what it was. Like I made a couple of buys, because I always ran two strategies, my short-term strategies and my growth portfolio. And it's
Okay.
very different kind of logic. And I remember like I take a couple of losing positions on my growth portfolio. And it's like I knew when I was putting them on, like from a short-term basis, I wouldn't be doing this if it was my short. So I
Right.
had these two sides of my brain. So I said, if institutions and I see these guys coming in buying every day for 3 months, if they can buy every day, why do I feel just because I'm using this strategy, I have to blindly follow it as I learned it? Why can't I adapt it to all the other tools that I learned that I know work short term? Because
Right.
sometimes I was being stopped out because of a bad short-term entry, but the longer-term idea was correct. So I said, look, one of my skills that I've fortunately developed is a great short-term entry pattern. So that's how I kind of, at one point I said, like, why don't we like join all the skills that we have instead of keeping them separated?
I love that. I literally
Yeah.
love that. That's so one of my favorite strategies that I use. It's kind of like it's a bit of an abomination, but it's like in options we have diagonals. So a big strategy that my mentor liked to use was leap diagonals. Then we, add a ratio to it. But long story short, on the strategy, it really capitalizes on a lot of that, where the entire base of the trade is typically over a year in terms of,
Mhm.
assessment, thinking, from here to here, we're expecting it to go up or down over the course of a year. But there's a short term component to that trade. It's one of my favorite trades.
Oh, very
And
interesting.
it's designed exactly, kind of like you're explaining your approaches, which is interesting to hear that with like an equities base. I'm fascinated by that.
Mhm.
So thinking and just being mindful of your time, but I would be remiss if I didn't ask a couple questions about just your general technical approach. So when you think about that some of the stocks you're looking at, do you typically arrive at your stock picks by looking at your portfolio and saying, I need to fill this gap, whatever that risk gap looks like if you want a specific product, or are you generally looking at the market and just saying, well, this looks interesting to me, or this looks like an opportunity? Do you start at the portfolio, or do you typically start by looking at the market and seeing what opportunities are there?
So portfolio wise, obviously I'm a trader, so I always want to be like 200% invested, right? But so
Yep.
it's I have to always hold myself back. So I usually use the market in general, like the way I look at new highs, new lows to kind of gauge my exposure. I have some rules for,
Okay.
should I be fully invested? Should I have 30% cash, or should I be at least 70% cash? So I have kind of a technical gauge just to keep me on the road instead of being too off of what the market's telling me. But that's kind of like my big picture idea. But typically what I do is I run a lot of scans to find which stocks have the biggest growth numbers fundamentally. And then of those, I want to see which are performing the best technically. And then the market's telling you the story, right? So for
Yep.
example, let's say, I don't know, let's think of a company like, or let's go back to, we were talking 2020, like this company, Livongo, has 200% earnings growth and it's 5% from its 52-week high. Well, okay, something's going on. The company's obviously doing it fantastically fundamentally. The market's recognizing that because it's paying up, it's at its 52-week highs. What is going on? So then that's why I like to dive into the story of the company. You can go to investor relation website, CEO, read online, and okay, this is what they're doing. And when you do that enough times, eventually, no company is like an island.
Right.
If someone's going to do something, it's usually just a slightly better iteration of something else
Yep.
someone's already done. And then it's a matter of implementing. So when you do this with company after company after company, you kind of say like, oh, okay, that's the trend they're working on. And so then after once you see that, you start to build a picture of, will this scale? Who else is going to benefit? And once you build that idea, and then after these other companies that you thought would have benefited start coming in, oh, now they have huge monster growth and they're sitting at 52-week highs. Okay, so I guess that trend, so it's, you want to have an idea that you build with the fundamental basis, but then you want to have, okay, the market's recognizing it, the funds are paying up for it. How do I get on board with a good low risk situation? And that's kind of how I bring it together.
I love that. That's really a fascinating perspective, especially I think most of when I venture into individual stocks, I almost always start with fundamentals just to make sure if it's something that I get stuck in for a little longer than expected. Because again, for me, if I have to hold on to something for 3 years, I really don't care. I'll do it.
Okay.
It is what it is. I'll figure it out.
Not for me. If I can't use my money, I'm dead. So it's got to
Yeah,
work or it's got to go.
yeah. So when you're looking at fundamentals, it sounds like you're looking at kind of a very, I don't want to say stereotypical, but like just common concepts, like making sure that we're generating, cash is somehow, via earnings per share metrics or, revenue, whatever, just some sort of valuation metrics there. Are there any other like really fundamental tools that you like to integrate when you're looking at these stocks?
I think, if you boil it down, and you can go into academic papers and people can argue this way, that way, but earnings are what investors are going to pay for. And even if it's not current earnings, it's future earnings. For example, Amazon, for years, everyone argued like, oh, but they're barely making any money. Well, at that time, investors believed, though, they heard the message from Bezos. So they said, okay, you don't have great earnings now, but we believe you enough. You're executing enough on different variables that we're going to put that faith in you. So typically the earnings will be present, they'll be booming. The rare exception, that won't be the case, but then at least sales are going to be booming, right? So I mean, you can say I'll postpone earnings, but you better be at least selling the product and you're going to get the earnings later when you have more pricing power or whatever it is, So those are the two factors I look at, either, record earnings or at least the highest earnings of the past 8 or 10 years, or at least record sales or the highest sales of the past 8 to 10 years, but growing aggressively. Now, if you look at a company where let's assume it's a younger company. Those usually have the best growth stories. If this is the most money as a company you ever made, and you're going to grow by another 50% next year, and your sales have been up quarter after quarter, 40%, you are doing something right. Now, if the economy doesn't fall apart, or if you don't make a big mistake, as a company and you pivot the wrong way, you are selling a product that your customers love, and you're doing it well. So if you can continue executing like that, you're going to keep those earnings growing. And that's the best candidate to have huge upside. And this is where the asymmetry comes in. If you can find companies that are doing that, and if you're growing aggressively, your stock price is going to advance aggressively. So your upside is huge, because if you compound earnings growth of 30% over 4 or 5 years and institutions pay up, you're going to get hundreds of percent return. But if you're wrong and you're disciplined, you're going to lose 3-4% of your trade. So it gives you the chance to find a stock that has this huge runway that you can potentially really significantly, build with position building, like we mentioned, scale into size. And if you're right, you have this massive upside. But if you're wrong, okay, I lost what I was willing to lose for this trade. I can move on. So that asymmetrical setup, you could be wrong at the end of the year. You could be wrong 7 out of 10 times and have a great year.
Right.
So it's just a different, which when I was day trading, it was the opposite. I probably had, a success ratio north of 50%, but the gains were small, wins were small. So there's not a one perfect way to trade, but this is the strategy I'm using now. And that's the logic behind it. And I think for most retail investors, that's, the best way to approach the market, because that asymmetry is huge. And you catch one NVIDIA or Apple and you're retired,
It's interesting. So many thoughts coming to my mind when you say that, because I feel like for most retail traders, lower risk, high return is very appealing, which is, a version of, what you're discussing. We essentially want to control risk to the downside fairly tightly, but give ourselves runway to the upside. But I always feel like retail traders fuck it up for themselves, because when you look at like the behavior of, even there's a couple white papers that I really like. One of them is individual investor behavior, and it was by the University of California, Berkeley. And it talked about the propensity for retail traders to let losers run and cut winners short. Literally, they have the idea that you do, but they don't have the discipline to make it happen. What was, I don't know, your approach to allow, I always feel like cutting losers, it's difficult, but once you get used to it, it is what
Mhm.
it is. It's part of the business. But I find when I talk to people, one of the more difficult components once we get the risk under control is letting winners move. How do you arrive at that? Like, what's your approach to
Yeah.
letting some of these trades run, you know, 30%, 50%, 100%, whatever you're seeing? How do you, force yourself to keep your hands out of it and say, nope, I'm going to let this run. This is my strategy.
And it's hard because, for example, in 2020, Lavonga was my best trade, and that was up about 400%. So when you're already up 100%, to let it ride when
Right.
you have 200, it's very hard. But I was, and this concept you bring up is as old as investing is, because if you read the book Reminiscences of a Stock Operator, I
Yep.
don't know if you ever read that book.
Yep.
Jesse Livermore, that's written in 1927, and
Yep.
he's saying that men should fear when they hope, and they should hope when they fear, which is
Yeah.
people do the, because I think it's just that human nature of it's going to come back. And when you're making money, oh no, I'm scared I'm going to lose my profit. It's just, it's weird psychological block that almost most people have.
Yeah.
And another part of it is that people don't like to be wrong. So if you're making money and you
Right.
take your profit, you're right. If you're losing money but I don't
Yep.
sell, you're not yet wrong. You are
Yep.
wrong. Your broker will tell you wrong. The money's no longer there, but you can feel like you're not wrong.
Right.
And so I think I'm very, very, very fortunate that the first book that appealed to me was How to Make Money in Stocks by William O'Neill, because he really explained it in such a way that it made so much sense to me logically from day one, that it became part of my DNA as a trader. And that's probably
awesome.
why, you look at most traders, even professionals, a lot of them had a period where they blew up. I never blew up because I never broke the cardinal rule of risk, limiting risk. And he just really made it sound so simple. I think was it the dress story? I think he told, he's like, let's say you're a businessman and you buy red and yellow dresses, and the yellow dresses are not selling and the red dresses you're sold out. Well, what are you going to do? You're going to discount the yellow dress just to get rid of it. And you're going to take that money and you're going to buy some more red dresses. And I just said, I don't know, that just clicked with me. I said, like, yeah, if the stock's not trading, there's something wrong with it. Take it out and go.
Right.
Approach it like a businessman rather than a gambler. Let's say, like, come on, you got to come back. Like, people, because it's buying and selling and numbers are flashing, it has that gambling component.
Oh, of course.
Yeah. And it's very easy, that the line is very fine. It's more about how you treat it than what it is, whether it's gambling or investing or a business.
Totally agree.
But if logically you're going to approach it like a business person, then it totally makes sense to, hey, what's not working, get rid of it and start focusing on what's working. Because any business person in any business ever that was successful focused on what was executing in the company and getting rid of what wasn't. So I think if you just look at it from that perspective and you really internalize that idea in your mind, you won't be hoping anymore. So that you'll just, again, that just resonated with me from day one. So
yeah,
I had that out of me, and some people are going to have to work through that psychologically. But once you get that inside you and inside your mindset, for me, it's impossible to go the other way. I can't sit. When I see a stock turn red and I'm bleeding money, it like itches me to get rid of it. And most people it's the opposite. So I think it's just a mindset you have to build.
That's awesome. Yeah, that's just a really powerful story, and I really like that analogy, because I am one of those idiot traders that at one point had to go through that Phoenix from the ashes bit where nearly imploded. But you are a very rare exception to that, and it's actually really awesome to hear how you're able to do that. That's pretty impressive to me. Okay, so I have one other question. Again, I don't want to take up too much of your time. I really appreciate chatting with you. 2022, hell of a year coming up, especially here in the US. We're talking about 3 to 4 interest rate rises, one of them starting as early as March. They're talking about easing, the quantitative easing bomb, all these sorts of things. I am really curious just what your general hypothesis is for the markets, heading into 2022. Obviously, just based in the discussion on what we know right now, which is 18 Jan, and everything is subject to change based on new information, all that stuff. A lot of people get really wrapped around the axle when somebody's like, well, you said this. And it's like, yeah, I said that 3 weeks ago. Shit changes, man. Like, stay with the times here.
I'm not an analyst. I'm an investor trader. So if I said something, what's the saying? I can't remember now. I'm trying to think. I have very strong opinions, very weakly held. You know what I mean? So like when I'm on something, when I'm really onto something, like I'm going to be in there, I'll position my account, but if it doesn't work, like, oh, maybe I'm wrong. And I think that flexibility is important,
Yeah. I
So
love that.
I agree, so what my outlook, if I'm reading the market as I see it now, the Federal Reserve wanting to raise rates is the elephant in the room. The Federal Reserve is always the elephant in the room, actually.
Yeah.
But but the thing is, it's rare that the Federal Reserve is making big moves. So 2020
Right.
forced their hand, and now inflation is forcing their hand again. Usually,
Yep.
in the meantime, between major tightening or loosening policies, you kind of don't hear from them very much. So it's day to day is normal. But with them wanting to raise rates aggressively, that's definitely going to put pressure on the market. I mean,
Yep.
you're pulling money out of the market. The lifeblood of the market is money, and you're taking money away because you're making money more expensive. But the other side of that coin as well is whenever you raise or lower interest rates, you change which sectors are going to be attractive for institutional investors
Right.
within the market. That's why you're seeing technology get killed, and energy and other things are so strong because of inflation and all that. I think those trends are going to persist. The trade I'm most excited about now is probably the oil trade.
Oh,
Um,
interesting.
I think, again, this kind of goes back, funny enough to my early years, where, again, resource companies and my global macro perspective. But so many oil companies were really beat up last year. Well, now 2 years ago, 2020, because oil was negative at one point. I think
Right.
the March contract, they couldn't find
Yep.
storage for it. So when you're gonna, this is the way I kind of build my overall thesis, right? So when I'm approaching the markets, and I always time it technically. So the Fed's raising rates, that makes companies with current real earnings more attractive. If rates are going up and you're a tech stock promising me earnings 10 years from now, well, as rates are higher, it's more expensive for me to sit there and wait for those
Right.
earnings. So that's why that attractiveness shifts from high PE, lower no earning stocks, to lower PE, high earning stock. That's why that's the sector switch that the flows will be towards energy, I believe. A second reason I like energy is in the current oil environment, they're basically printing money. The profits are huge. Some of these companies are making record earnings already. They're very reluctant, especially American shale producers are very reluctant to put out more oil rigs, to take out more oil,
Right.
because they got slammed so hard.
Yep.
A lot of companies went through restructuring. Board of directors says, you're going to be very careful with what capital you put out, because we don't know, is COVID going to come back? Are they going to, keep putting pressure on oil companies for, climate change or whatever? So you're not going to go out there and put out more drilling unless you're really sure of the demand situation and the rest. Same with the OPEC countries, exact same situation. In fact, with Russia on the Ukrainian border, if there's some kind of a conflict, that would be even more pressure on the oil price. So you put all of this together, and I think personally, I don't know if you know Peter Lynch, who's the great investor,
Yeah.
Fidelity Investors.
Yeah.
His ethos was always buy what you know, buy what you like, buy the products around you. And these are these great companies. Well, I don't want to buy anything right now. What I want to do is I want to go out and live a normal life. I want to travel. I want to take a drive. And so if the world, I think, come out of this unfortunate situation, and depending where you are, there's still some rather big restrictions. If everyone starts driving again, flying again, even if it's incrementally, but in that direction, because oil companies and oil producing nations are so restrictive and careful in putting out new supply, your supply equation is very tight for oil. That's why you see
Right.
President Biden put oil out with the Strategic Petroleum Reserve. What happened? Oil fell, whoop, right back up. It was just
Yep.
consumed by the market. So that's telling you the market is already very tight. Supply is very tight. And if that demand comes on, even if it's 2, 3, 4, 5, 6 months from now, people say, that's it, I want to take a drive. That increase in demand, I think, could take oil up significantly. And on top of that, with inflation, put yourself in the shoes of the OPEC nations. Our oil will still start your car, but your dollar, we can't buy the same amount of bread at the store because the dollar's been printed. So they're not as willing to accept lower prices for the oil. So all of this, to me, provides a backdrop where there's an asymmetric setup on oil. The downside's limited. Maybe my idea could be wrong. Maybe we come down a little bit, but if I'm correct in my analysis, can you see $100 plus oil? Absolutely.
Sure.
And if the oil companies are already doing great now,
Yep.
well, if oil gets to 100 plus, they're really going to be killing it. And also then if you look at higher rates and institutions moving towards these current earnings type companies now, I can see this place where this funnel torrent of money can come in these oil stocks that have been so out of favor for so long. And technically the action is great. Again, you can have all of these ideas and pass on them. But for myself, why I'm actually committed, I've been buying oil stocks for a little while now, is technically they're acting great. Who's making 52-week highs? It's not tech stocks this year, it's oil stocks. So the market is agreeing with me, and no one's paying attention because oil is no longer sexy, right? It's supposed to be about green investing and all of that. And so it's kind of been abandoned, but when the earnings come, the money will follow. It's just the law of the market. So that's how I'm reading the market. I think you're going to see pressure on general markets in general. I think probably growth stocks are going to wash out sometime later this year because it's already a year they've topped. I mean, we topped basically February 2021 for a lot of growth stocks. So, but in the meantime, I think the best upside trades probably oil. Beyond that, I think general market gains are going to be limited just because the Federal Reserve is going to be this big weight on the market.
Yeah, I think that's a obviously really comprehensive analysis. I feel like a lot of what we experienced in COVID was an experiment by the Fed, and I think that you know we don't know how the story ends.
Mhm.
I'm generally just market bearish, like going into this year. Not to say that the year couldn't end up, but I don't think we're seeing 29% return this year. With
Mhm.
everything coming towards us, and it's also interesting that you highlight oil specifically. So I do a live session pretty much every Monday, and
Mhm.
I just bullshit about the markets, whatever. And anyways, for the last few weeks, I like to pull up a sector performance of the S&P 500 and just look at it essentially week over week. And energy has been at the top. And obviously, you've already arrived at that conclusion and have been moving your way into oil. Just an interesting point. I'm curious your thoughts on with regards to oil. Is your trade hypothesis something within a year, or are you expecting slash planning for like a longer term upside to oil? And I ask that just because for me, I think there definitely is short term potential in oil, but I really do feel like in a lot of ways its head is on a chopping block once we start getting out like 5+ years, like way further out in time. I
Yeah.
don't think we're getting rid of oil anytime soon. I think it'll be around for the foreseeable future, but I do feel like they're constantly under fire, for something. So I'm just curious, when you discuss your trade hypothesis, what's the kind of time frame that you're thinking
Yeah.
for that?
Yeah, it's usually like 12 months out. Like
Got
again,
it.
most of my trades are 3 months to 9 months. Can they go maybe a year and a half? Sure. But that's the rarity, but that's usually like the wheelhouse I like to focus in because once you start getting beyond 9 months or more, even if it is a 5-year trade, let's say you have this great 5-year vision, you're gonna have to sit probably through some points where three,
Yeah.
6, 9 months where the stock consolidates, drops hard, underperforms. Again, myself is where this is what I do for a living. I don't have the ability to just sit there and say, oh, okay, I'm going to sit here for 9 months and have the stock fall 30% while the S&P I'll rotate elsewhere. I just know it's my personality. And I think at a certain point, you really have to pick what works for you as a person and your situation. So that's what works for me. So I never myself even focused on 5-year projections because it doesn't
Got
really
it.
interest me. I'm shorter term guy. So it's really that 3, 9 months, 12 months is the wheelhouse I usually focus on.
Got it. Okay.
Yeah.
And to wrap up, I do have one last question. I am curious. I think the technical analysis folks from my community would probably hang me up to die if I didn't ask you this. Um, when you think about you obviously mentioned a few times your technical tools, looking for confirmation. What are your top 2 or 3 technical analysis tools that you deploy?
I think critical for me are the bases that William O'Neill taught about.
Got it.
I mean, some of them are even textbook. I mean, technical analysis bases, but there's real specific criteria he provides. So I think that's just so important to start with on a foundation of which stocks to look at. I mean, and it's not just the shape of the pattern. People think it looks like a head and shoulders or this or that. There's also depth requirements. That it's got to be a certain length of time. And the way he got to these parameters is he went back to look at all the best stocks as they had their major advances in history. And he looked
Mhm.
at the basing patterns to find what are all the commonalities in the minimum criteria. Because a base, if you're just looking at a technical price action, you can see that on a 5-minute chart, you can see it on a
Right.
monthly chart.
Right.
But if you're looking for these stocks, they're going to have these explosive runs as they're being accumulated by institutions. They have a commonality as to how they form these bases. So that would be
Mm.
step one as to what I do. Um, I think just people have varying experience in technical analysis. Just something basic like the 50-day moving average.
Yep.
Like keep your stocks above the 50-day moving average for your purchases. I mean, if you're below there, I mean, you're dealing with a stock that's maybe either in a correction or has already started a downtrend. So just at least above a 50-day. And beyond that, well, the technical tools, there's many that I use. I'd probably have to show you on a chart, but I think there's no real super secret. I've picked the ones over the years that I feel are most effective, that work best with me, for me as well, I would say, but keep a variety. So by that, I mean, some people, let's say like an oscillator, some people like short-term chart patterns. If you have a variety for different types of situations, not every stock advance will be the same. So for sometimes a stock advance is quick and you'll get like a flag pattern because it's a quick pattern. Sometimes it's a little bit slower and other patterns will show up. So, if you have a larger, a diverse set of tools, you'll be able to capture entries on a variety of type of stock moves. That's the way I would look at it. So
Awesome. Yeah, that's really helpful. Thank you. I'd love to, set up another session with you sometime to chat about that a little bit more because I know a lot of people are super interested in that, and it would be really cool, even for me to learn a little bit more about your general technical analysis approach because I'm kind of similar in that way where again, most of what I do is via what I learned from that mentor of mine. I mention him so frequently not to talk about it like it's this mysterious dude, but it's because I don't feel comfortable taking credit for most of what I do because it literally is from him. But anyways, he was really big into like super simple, technical analysis. He uses like 150-day moving average, 50-day moving average, and that's about it. So
it's funny. Most people I know, after years of experience, become very simple, myself included. I did my chartered market technician, the CMT designation, which is everything technical analysis. And I used to have oscillators, indicators, and bands and all this on my charts. And right now my charts are so simple. It's just candlestick charts with my moving averages. Other tools I use like net highs and lows is like it's breadth. It's not, it's the market itself composition. It's not a technical indicator, the same definition. And so I've just become so simple over time. And my goal now is less about, looking at all these lines and indicators, more about trying to understand, are institutions net buyers or net sellers? So I come to the stock chart, not by trying to see a pattern, but trying to read what is the pattern telling me. I think that's a really important distinction to make.
Yeah. I think that is a kind of a profound distinction because a lot of people see a chart and they try to impose whatever their analysis says.
Absolutely.
That's a really profound statement. And then I think I lied to you because I have one final question. Do you use any sort of like volume profile or VWAP, anchored VWAP, anything like that? Because it sounds like when you're talking about institutional pricing that those tools, at least for me, come to mind. But I'm curious if that's something that you use for that.
It's not something I use, to be honest. Really, I like to look at the volume on the chart versus what a stock average typically trades in a day, but I never really got beyond that. What I find a very key important tool, and it's nothing I created, but if you're buying a stock during the day that's breaking out or something, and these are kind of more advanced discussion, but the day is not created equal. So for example, at 10 o'clock in the day, you're only a small fraction into the day. So if you just kind of say like, oh, let's say we're 10% of the trading day is complete. Are we doing 10% of the volume? That's not a fair analysis. You have to know how much your stock typically trades in the first half hour. Because, most stocks, the opener, that's their most active time of the day. So in real time application, you want to know, is it above average volume, but is it also above average volume for that time of day? So that's like a way I like to use volume real time when I'm putting my position on, to understand, is this move real right now? I mean, either I'm buying on a pullback or consolidation, but if I'm buying into strength because I think there's a breakout or something, happening, that's an important way I like to approach the market.
Got it. Yeah, that's awesome. Thank you. I was just curious. I hear a lot of discussion about some of those tools. So, well, I have thoroughly enjoyed talking with you. Obviously, you're a great conversationalist. You're just fun to chat with about the markets. You have a ton of great information. So thank you so much for taking some of your time to share it with us. We really appreciate it.
I appreciate being here, and everything yourself as a Marine and a veteran, everything you guys have done for us, keep freedom going. This doesn't just keep going on its own. So I appreciate that.
And most of the people appreciate that sentiment as well. You mentioned earlier that you have a website, could you just give us like a quick overview of, what's on there, what people could look for?
So if you go to carusoinsights.com, insights plural, right now I have a course where basically my entire approach from A to Z is what I talk about. After the competition, a lot of people reached out to me. I just realized, books are great, but people like a video interface. So the course is video based, but really like less, module one is mindset. So it's really about stepping through the entire journey as a trader, as an investor, and it's focused towards growth stock. That's why it's called the active growth investor. And it's sold very successfully. I'm very proud of that. What I'm most proud of is I only have 5-star reviews. So the reaction I've got from members has been, the biggest reward that I've gotten.
Of course, a
And
5-star review, that's super noteworthy. Let's talk about that for a minute, because the age of the internet keyboard warrior, somebody's always pissed about something. So
I agree.
that's
I agree.
that's
I'm so, I set up like this automation, like, ask for a review. And I said, I'll see what happens. I hope to be good reviews. And I've only gotten, I think, I forget how many I have now, but I'm proud of that. And there's been such a good demand. I'm actually starting a new product in February where it'll be kind of like a interactive subscription service where,
cool.
video calls twice a week and daily little markup roundups and all that, so if you sign up on the website to the newsletter, you'll get information about that when it comes out. So
awesome. Yeah, great. Thanks. I'm always interested in connecting people with resources. And obviously I love a lot of what you talk about. So thank you for, sharing a little bit of that with everybody too.
My pleasure. Absolutely.
Cool. Well, until next time, thank you so much for hanging out for a while. And I definitely look forward to chatting with you again.
You got it.
All right. Take care, Matt.
Bye.